I'm John Lesky, recently retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. This is the third video of a 4-part series on asset allocation. Last time, we looked at the considerations for deciding on your target asset allocation. In this video, we examine how to calculate your current asset allocation consistent with developing an investment strategy for achieving your target asset allocation by financial independence and/or retirement. In our view, for those who expect to continue to accumulate wealth from business or employment earnings, the traditional ways of measuring asset allocation are not very helpful. We think a better approach to asset allocation takes advantage of the projected lifetime investment wealth framework developed at my previous financial planning firm, Wealth Foundations. It takes a much broader view of wealth and provides valuable insights relevant to answering many typical personal finance questions, such as how much could or should I borrow? How should I build my risky growth asset exposure over time? And can I afford a larger home? To illustrate the approach, let's examine the Barber family situation. The Barbers are the case study family used in our What is FinHealth video blog series. Their current summary balance sheet is shown on the screen now. The Barbers have nominated that $100,000 of the total $1 million in investment assets are held as defensive assets, implying $900,000 is held as growth assets. They have also made it clear that it's their desire to never have to sell lifestyle assets, valued at $2.5 million, to fund ongoing spending beyond the time they stop working. As a result, there is no need to take account of any expectation to sell lifestyle assets as a potential source of investment wealth. This may not always be the case. Traditionally measured then, their asset allocation only considers their investment assets and is as shown on the screen. We'll call this the asset-based measure of asset allocation. A 10% defensive, 90% growth allocation is indicated. The Barber's target growth asset allocation is 60%, so the traditional approach suggests an overweight growth assets position of 30% that needs to be closed between now and the proposed retirement in 19 years. However, the total investment assets of $1 million are not a measure of the current funds available to the Barbers to live off if they weren't working. They need to be reduced by outstanding debt. Borrowings are effectively a negative defensive asset. We call the difference between investment assets and borrowings net investment wealth. The calculation of net investment wealth and a revised asset allocation is shown on the screen now. Based on net investment wealth of $800,000, the Barbers have 112.5% in growth assets and a negative 12.5% in defensive assets. They are a massive 52.5% above their target growth asset allocation target of 60%. But we also don't think net investment wealth is a true reflection of the Barbers' total investment wealth for asset allocation purposes. Between now and their proposed retirement in 19 years' time, based on inputs they provided, the FinHealth personal finance software calculates they will save about $1.342 million from the surplus of their projected after-tax incomes over their projected spending. This is after allowing for spending $1.5 million to upgrade their residence. We call these projected savings their future capital. In our view, it's as much a part of the Barber's wealth as conventional investments like cash or shares and property. Admittedly, it's an estimate that will fluctuate over time as circumstances change. Until actually saved and invested, we regard future capital as a defensive asset. Depending on your confidence in the estimate, you may choose to discount the calculated amount for uncertainties. But going with the Barber's estimate, on this basis, total defensive assets are now $1.24 million. That is, future capital of 1.342 plus actual net investment assets of minus $100,000. The chart on the screen shows the allocation of the Barber's projected lifetime investment wealth. That includes future capital. It reveals that the Barber's current asset allocation is 58% defensive, 42% growth, and 18% overweight defensive position when compared with their target asset allocation of 60%. It suggests an entirely different view of the Barber's risk exposure than the simplistic asset-based asset allocation measure. The projected lifetime investment wealth approach puts the Barber's current growth asset holdings of $900,000 into a lifetime context. While they may appear large relative to current investment assets, when compared with the funds expected to be available for investment in the future, they actually need to increase over time to achieve the target asset allocation by the proposed retirement date in 19 years' time. The chart on the screen now shows how the Barbers are projected to increase their growth allocation to 60% by Pete's retirement in 19 years, based on the hard-coded assumptions provided in the FinHealth personal finance software. The growth allocation declines to under 30% at the time the Barbers upgrade their residence in 3 years' time, and then progressively increases to the 60% target at Pete's age 67. The software actually forces the alignment of the actual growth allocation with the target at the desired retirement and/or age of financial independence. However, in reality, there are an infinite number of paths to the 60% target growth asset allocation ratio. The Barber's investment strategy should focus on how they're going to transition from their current growth asset allocation of 42% to the 60% target growth asset allocation over the next 19 years. The issue of transition is the subject of the final video in this asset allocation series that will be posted in 2 weeks. So, I'll see you then. Please provide any comments or questions below. And finally,